Let me finally make some comments about the housing market. The red line there looks at dwelling approvals going back to 1957. So what you can see is that at the moment we're building more houses or having them approved, and not houses, accommodation than ever in the past by a long stretch of the imagination. The grey area looks at times when they're raising interest rates. So what you see there, if you look at all those peaks in the construction cycle in the past, they've always turned around as a result of them raising rates. Governments get nervous, central banks get nervous, they start to see inflation, bang, and they stop the party. Well, what we know this time is that they're not going to be raising rates. Some well-meaning characters believe they'll be raising rates next year, which I think couldn't be further from the truth. So we are going to go through a period of this year and next year where rates are going to remain firmly on hold. That suggests to me that whilst we are probably at the peak, the pace of slowdown is going to be pretty modest. So the activity levels that have been benefiting so many parts of the economy, I think are going to hold up really well. And then, of course, as we know, a substantial part of the demand is offshore. We estimate that about 40% of the high-rise demand is going directly to FIRB investors. These are people that are genuinely offshore investors. And there's absolutely no reason to see that changing. The anti-corruption laws in China aren't getting any easier. People are expecting to see the RMB falling further. Money's leaving China. So this boom that we're seeing, I expect to hold up pretty well. But what about prices? Wow, what about prices? If we look at the 6-month annualised pace of house prices, dotted line is Sydney. In the last 6 months, Sydney's house prices have risen by 26% annualised, so 13% in 6 months. Just when people thought they'd slow down, they've had another lift. Melbourne, even more interesting. It looked as if Melbourne was on its knees. Auction clearance rates were falling. In the last 6 months, Melbourne prices have lifted as well. And we're even starting to see some further recovery in Brisbane. Now, clearly, the 26% isn't going to be sustained. But the question is, will they fall? Will they collapse? I'd be surprised. I think that we've still got the underlying demand story there. Interest rates are going to remain on hold. And whilst the pace of price appreciation has to come down, if you look at those arrows, you think, oh my God, they're predicting disaster. No, we're just saying that in the next couple of years, the price appreciation won't be 25%, it'll be more like 5%. But it's still positive. It's not a collapse in prices. You can see those periods where prices collapse. Back in that 10-11 period, that was when they raised rates. The Reserve Bank raised rates from 3% to 4.75%. Bang, 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 bang. Totally inappropriate, but they did it, and that affected house prices. You can see that 07-08 period where prices fell. Reserve Bank was raising rates. If you recall, they raised rates in March 2008. The GFC was known by everybody, apparently, apart from the Reserve Bank. And that, of course, led to some damage in the market. So with rates once again on hold, I don't see the case for prices to collapse. And if we look where the safest market is, one of the factors that people argue will be behind the fall in prices is oversupply. And certainly, if you're looking at the so-called housing shortage across this nation, New South Wales really stands out. If you look, we estimate that about 60% of the housing shortage is in New South Wales. So if I was looking at a riskier market at the moment, I'd look at Victoria, where they have very little shortage. So you can supply more stock into the New South Wales market without suddenly running into an oversupply, whereas if it happens in the Victorian market, you'll run into oversupply a lot more quickly. And that's certainly some of the anecdotes that we know, that we're aware of. We look at a statistic such as what proportion of off-the-plan investors are actually losing money, and it's quite substantial in Victoria. But in New South Wales, with this ongoing shortage of housing, it looks like a much safer market. So if I look at the Sydney house prices that have done 26% compared to 8% in Brisbane and 4% in Brisbane and about 12% in Melbourne. Do I say Sydney's the one that's overvalued? Well, Sydney house prices are really only just getting back to the long-term average ratio to the rest of the country. They're just slightly above at the moment. We haven't actually been at that average since about 2002, 2003. So I don't really expect that the Sydney market is what I would call overvalued and likely to bust. But people, whenever I travel offshore and talk to my customers, or whenever I see international investors that want to come to see me, they'll always talk about a story like that. And that story is, look, house prices have, if we take, say, Sydney, over the last 20 years, house prices have gone up by 250% and incomes have only doubled. So prices have run so far ahead of incomes, you must have an overvalued market. So any measures of price to income ratios, your market's overvalued. That's easy, it's simple, isn't it? Of course that's the case. The problem is that when you're evaluating housing markets, you should be looking at the serviceability of the debt, not of the actual price. And the serviceability of the debt has changed a lot because interest rates have come down so far. And as we said before, the outlook is that interest rates will remain much lower post-GFC than we had before the GFC. So the idea that we'd have interest rates going back to that sort of 17, 20% mortgage rate level, I think is just fanciful. And if we look at the servicing ratio, which is the proportion of your income needed to service a debt, that's around long-term average at the moment. If we were to see a 1% rise in interest rates, you'd be around the 10-year average. And if we look at what the people are saying for the US, what are they saying for the US? 2 rate hikes over the next 2 years. I think that's ridiculously cautious, but you know, we're dealing with, I might say there's going to be 4 or 5. They think 2. If in the markets, that's a big deal, but in terms of servicing mortgages, it's not. So I don't really see the servicing issue as being a problem because it's the interest rates that have changed. So price to income ratios really do mislead you. In terms of affordability, your ability to raise a deposit, yes, it is price to income that counts. But once you have the loan, it's the serviceability of it related to the interest rate that counts. But of course, the authorities in their wisdom have been terrified about a housing bubble. So they have introduced some regulatory controls. And what control did they introduce? Well, they looked at the growth in new lending and noticed that most of the growth was happening in the investor sector. If you looked at that number, that annual number 2 months ago, you would have seen 25% investors and about 6% owner-occupiers. But since the banks have raised their rates on investor loans, miraculously, a lot of people have called the banks and said, hey, you know that loan was an investor loan. It's actually an owner-occupier loan. Can we please reclassify? And the banks have been very compliant in this. So it looks as if investor loans have slowed down a lot and owner-occupier have picked up, but really it's more of a reclassification thing. But the authorities, in their wisdom, have decided to attack investor loans. And it's representing some potential risks for our market. If you look at the growth in investor loans in previous cycles, it's been up at around 30%. And if you look at the growth this time, the authorities want to contain that at around 10%. And included in that 10% is a component of the banks lending to offshore borrowers that's running in multi-double-digit pace. So the actual loan in growths to the domestic borrowers is well below 10%. And that is constraining the market and creating some imbalances. I'll give you an example. A developer does pre-sales. Now a bank looks at the pre-sales and says, well, gee, a lot of those pre-sales to people who may not actually be able to get their funding when the time comes around for them to pay up, because we don't know how restricted our loan book will be by then, given these regulations. So it is creating a number of imbalances in the market. And as I said, what are the sources of growth in the economy? The construction sector, the tourism sector, the health sector. These constraints are actually making it more difficult to get as much construction as we believe the economy could cater for. So what you would normally say in a situation like that, when you have regulation, it just blurts out into the unregulated sector. The trouble is that the banks control about 93% of that market. Pre-GFC, the banks only controlled about 80%, but the securitisers who used to do a lot of their funding offshore are now constrained because the European markets are still closed as a result of the GFC. So really, the banks control that investor lending market, and we are seeing substantial imbalances and distortions coming about as a result of the regulators getting involved in this market. And if I was to look at one risk around these markets, it's undoubtedly the distortions that a lot of us can't even think about, can't even imagine. I've given you one example. Someone who now goes and buys off the plan can't be certain they'll get their funding at the time when they actually have to front up with the money. It's not a guaranteed commitment that banks can give for 2 or 3 years. So that's creating a lot of uncertainty. And the fact that you don't have a big enough unregulated sector, it can create those distortions.